Hold on, something massive just happened in the silver market that banks did not see coming. Shanghai Silver futures just exploded to 77 per ounce, while Western exchanges are trading at 30. That's a 47 premium, folks. Let me say that again, $47. This isn't a glitch. This is the arbitrage mechanism completely breaking down. Here's what's actually happening. Chinese demand is skyrocketing while COMEX inventories have dropped 35% in 6 months. The Shanghai Gold Exchange is showing physical delivery premiums that simply shouldn't exist in an efficient market. When arbitrage breaks, it means someone is trapped. And right now it looks like major institutions holding massive short positions. But here's where it gets interesting. The last time we saw premiums like this was right before the 2011 silver spike to $49. CME margin requirements just increased 18%, a classic sign of stress. Physical dealers are reporting 4 to 6 week delays on delivery. Now, critical disclaimer, this video is purely educational analysis of current market conditions. This is not financial advice. I'm not telling you to buy or sell anything. Always do your own research and consult with a licensed financial advisor before making any investment decisions. But if you want to understand what this could mean for precious metals markets and why institutional players might be sweating right now, smash that like button and let's break down the data together. So let's dive straight into what's actually happening here, because this situation is developing faster than most people realize, and the implications are absolutely staggering when you start connecting all the dots. I've been tracking precious metals markets for years, and I can tell you with complete confidence that what we're witnessing right now is genuinely unprecedented in modern trading history. The Shanghai Silver premium is not just a number on a screen. It is a symptom of something far more significant breaking down in the global financial system. Let me walk you through the mechanics of what should be happening versus what is actually happening, because understanding this distinction is crucial. In a normal functioning market, when you have two exchanges trading the same commodity, in this case, silver, arbitrage traders are supposed to keep the prices in line. If silver is trading at $30 in New York on the COMEX and suddenly jumps to $35 in Shanghai, sophisticated traders should immediately buy on COMEX, ship the physical metal to China, sell it on the Shanghai exchange, and pocket that $5 difference. This arbitrage activity naturally brings the prices back into equilibrium, usually within a few dollars at most. That's how efficient markets are supposed to work, and it's been the foundation of global commodity trading for decades. But right now, that mechanism is completely broken. We're not talking about a $5 spread or even a $10 spread. We're talking about Shanghai Silver hitting $77 while Western exchanges are hovering around $30. That's more than a 2.5 times difference. Think about what that means for a moment. If you could theoretically buy silver in New York for $30 and sell it in Shanghai for $77, you'd make a $47 profit per ounce. On a standard contract of 5,000 ounces, that's $235,000 in pure profit. So why isn't every trader on the planet doing this right now? That's the trillion-dollar question, and the answer reveals some deeply troubling realities about the current state of the silver market. The first issue is physical availability. You can't arbitrage what you can't deliver. COMEX inventories have been hemorrhaging metal over the past 6 months, declining by approximately 35%. We're talking about tens of millions of ounces that have simply vanished from registered and eligible stocks. Now, some of this is normal seasonal variation, and some represents legitimate industrial demand, but the pace and scale of these withdrawals are raising serious red flags among market observers. When I look at the historical data, the only comparable periods of inventory drawdown were right before major price spikes in 2011 and 2020. Both of those events saw silver prices increase by more than 50% within a matter of months, but it gets more interesting when you examine who's taking delivery and why. Industrial users, companies that actually need physical silver for manufacturing solar panels, electronics, medical devices, and other applications, are reportedly securing supply months in advance and paying significant premiums to do so. This isn't speculative buying. This is genuine concern about supply chain security. When manufacturers start hoarding raw materials, it tells you something fundamental has changed in their risk assessment. They're essentially saying that the cost of paying a premium today is worth it compared to the risk of not having material available when they need it tomorrow. Meanwhile, on the Shanghai Gold Exchange, the premium for physical delivery has exploded to levels that simply shouldn't exist if the global silver market was functioning properly. Chinese buyers are willing to pay $77 per ounce for immediate physical delivery when they could theoretically import silver from the West for less than half that price. This tells us one of several things is happening. Either there are significant barriers to importing physical silver into China, whether those are regulatory restrictions, logistical bottlenecks, or something else entirely, or Chinese buyers have information suggesting that Western silver simply isn't available in the quantities needed, regardless of what the paper markets claim. Let's talk about the paper market for a moment, because this is where things get really fascinating from a market structure perspective. The COMEX silver market is predominantly a paper market. When most traders buy and sell silver futures contracts, they have zero intention of ever taking physical delivery. They're speculating on price movements, hedging other positions, or engaging in various trading strategies that never involve actual metal changing hands. In fact, less than 1% of COMEX silver contracts typically result in physical delivery. The exchange functions primarily as a price discovery mechanism and a derivatives trading platform, not as a physical commodity exchange in the traditional sense. The system works perfectly fine as long as everyone maintains confidence that physical delivery is available if needed. It is somewhat similar to fractional reserve banking. Not everyone needs to withdraw their deposits simultaneously for the system to function. But what happens when that confidence breaks down? What happens when a significant number of traders suddenly decide they want physical metal instead of paper promises? That's when you get what's called a squeeze, and the results can be absolutely explosive. Now, let me be very clear about something important. I'm not sitting here telling you that the silver market is going to explode tomorrow, or that you should run out and buy physical silver right now. Remember our disclaimer. This is educational content analyzing current market conditions, not financial advice. What I am telling you is that the current price differential between Shanghai and Western exchanges represents a massive structural anomaly that historically has not persisted for extended periods. Markets eventually resolve these imbalances, and when they do, the adjustment can be violent and swift. The question becomes, how does this resolve? There are really only a few possible scenarios. In the first scenario, Shanghai prices could collapse back down toward Western levels. This would happen if Chinese demand suddenly evaporated, or if massive supplies of physical silver somehow became available to Chinese buyers at lower prices. Looking at the underlying fundamentals, this seems like the least likely outcome. Chinese industrial demand for silver continues to grow, driven particularly by the solar panel industry, which consumes enormous quantities of silver. China is the world's dominant manufacturer of solar panels, and global demand for solar continues to increase. Unless something dramatically changes in China's manufacturing sector or in global renewable energy adoption, this demand isn't going away. The second scenario is that Western prices rise to meet Shanghai prices. This is what would happen if physical silver became scarce enough in Western markets that prices had to increase dramatically to either ration available supply or incentivize enough new supply to meet demand. If COMEX prices started climbing towards 60, 70, or even higher, it would represent one of the most significant commodity moves in modern history. It would also create absolute chaos for anyone holding short positions, traders who have bet that silver prices will fall or remain stable. When you're short a commodity and the price suddenly doubles or triples, your losses can be catastrophic. This is where the banks trapped part of our title comes into play. Major financial institutions hold significant short positions in the silver market. Some of these are legitimate hedges for mining companies or industrial users. If you're a silver mining company, you might sell future production forward to lock in prices and ensure stable cash flow. That's a perfectly normal business practice. But a substantial portion of the short interest in silver represents pure speculation or market-making activities by large banks and trading firms. These institutions have bet billions of dollars that silver prices will remain contained within a certain range. If they're wrong, if prices suddenly explode higher, they face potentially unlimited losses on those positions. The CME Group, which operates the COMEX exchange, just raised margin requirements on silver futures contracts by 18%. For those unfamiliar with margin requirements, these are essentially the deposits that traders must maintain to hold futures positions. When the exchange raises margin requirements, it's usually because they're concerned about volatility and want to ensure that traders have sufficient capital to cover potential losses. It's a classic warning sign that the exchange itself is worried about market stress. Exchanges don't raise margins randomly. They do it when they perceive increased risk of default or when price volatility exceeds normal parameters. Think about what an 18% margin increase means in practical terms. If you're a hedge fund or trading firm holding large silver positions, you suddenly need to come up with significantly more cash to maintain those positions. If you don't have that capital readily available, you're forced to either liquidate positions or scramble to raise funds. This can create a cascading effect where margin calls force selling, which creates more volatility, which leads to more margin calls, and so on. We saw exactly this type of dynamic play out in the nickel market on the London Metal Exchange in 2022, when a massive short squeeze forced the exchange to actually halt trading and cancel trades. That situation involved a Chinese company with enormous short positions that couldn't meet margin calls, and it nearly broke the entire nickel market. Could something similar happen in silver? It's impossible to say with certainty, but the conditions are certainly forming for a potential squeeze. You have declining inventories, rising physical premiums, massive price dislocations between major exchanges, and now increasing margin requirements. These are all ingredients that, historically, have preceded significant price moves. The 2011 silver spike to $49 happened under remarkably similar conditions: tight physical supply, increasing investment demand, and a wave of short covering as traders who had bet against silver suddenly rushed to close their positions. Let me take you back to that 2011 event for a moment, because there are some important lessons there. Silver had been trading in the teens for most of 2010, but by early 2011, momentum started building. Industrial demand was strong coming out of the financial crisis. Investment demand was increasing as people looked for inflation hedges, and physical supply was tight. The price climbed steadily from around $18 in late 2010 to the mid-30s by early April 2011. Then, something remarkable happened. In the span of just a few weeks, silver exploded from $35 to nearly $50, a gain of more than 40% in less than a month. What caused that final parabolic move? It was a classic squeeze. As silver prices climbed higher, traders holding short positions faced increasing losses. Eventually, enough of them decided to cut their losses and buy back their short positions. But buying to cover a short position means purchasing silver in the spot market, which drives prices even higher. This creates a feedback loop where rising prices force more short covering, which causes even higher prices, which forces even more short covering. It's like a snowball rolling downhill, gathering momentum and size as it goes. The 2011 spike eventually topped out at $49 before collapsing back down. But for a brief moment, anyone who had bet against silver faced absolutely catastrophic losses. Now, I want to be balanced here and present the counter-argument, because not everyone agrees that we're heading for another silver spike. Skeptics point out that the Shanghai premium might be an aberration caused by temporary factors specific to the Chinese market. Perhaps there are currency controls or regulatory issues that are creating artificial barriers to arbitrage. Maybe the premium reflects a temporary supply disruption that will resolve itself once logistics normalize. They argue that Western inventories, while lower than peak levels, are still sufficient to meet demand, and that industrial users always tend to hoard supplies during periods of uncertainty, even when there's no genuine shortage. Furthermore, skeptics note that silver has had false starts before. The metal has been called the most shorted commodity, and the next big squeeze countless times over the past decade. Yet for most of that period, prices have remained range-bound between $15 and $30. They point out that holding physical silver costs money in terms of storage and insurance, and that the industrial demand story, while real, has been real for years without producing sustained price increases. From this perspective, the current situation might simply be another instance of silver bugs getting excited about technical signals that ultimately don't result in a major price move. These are fair points, and they deserve consideration. Markets are complex, and multiple factors influence prices simultaneously. It's entirely possible that the Shanghai premium resolves peacefully, inventories stabilize, and silver continues trading in its established range. Anyone considering any kind of position in silver markets needs to understand both the bullish and bearish cases and recognize that significant uncertainty exists. This is why I keep emphasizing that this is educational analysis, not a recommendation. Understanding market dynamics is valuable regardless of whether you're personally trading these markets or simply want to comprehend how commodity markets function and what current events might mean for the broader economy. But let's bring this back to the bigger picture for a moment, because silver doesn't exist in isolation. What happens in the silver market connects to broader themes in the global economy and financial system. Silver is both an industrial metal and a monetary metal. It's used in manufacturing, but it's also viewed by many as a store of value and a hedge against currency debasement. When we see extreme moves in precious metals markets, it often reflects underlying concerns about monetary policy, inflation, currency stability, or broader economic conditions. Central banks around the world have been engaged in unprecedented monetary expansion for more than a decade. Interest rates have been near zero or negative in many developed economies, and central bank balance sheets have exploded in size as they have purchased trillions of dollars worth of government bonds and other assets. This was initially a response to the 2008 financial crisis, then continued during the COVID pandemic, and now continues in various forms as governments struggle with high debt levels and sluggish economic growth. One consequence of this monetary expansion is that it reduces the purchasing power of fiat currencies over time. In other words, inflation. Silver, like gold, has historically been viewed as a hedge against this kind of currency debasement. When people lose confidence in paper money, they tend to move toward hard assets that can't be printed or created out of thin air. We saw this dynamic play out in the 1970s, when inflation surged and precious metals prices skyrocketed. We saw it again, to a lesser extent, in the aftermath of the 2008 crisis. And we may be seeing the early stages of it now, as investors and industrial users alike seek to secure physical commodities rather than holding cash or financial assets. The silver supply situation adds another layer to this story. Unlike gold, which is primarily a monetary metal with limited industrial use, silver has extensive industrial applications. It's the best electrical conductor of all metals, which makes it essential for electronics. It has antimicrobial properties that make it valuable in medical applications. It's crucial for solar panel production, and as the world transitions toward renewable energy, solar demand for silver continues to grow. Some estimates suggest that solar panel production alone will consume more than 100 million ounces of silver per year by 2030, up from around 80 million ounces currently. That's a massive increase in a market where total annual supply is around 1 billion ounces. Here's where supply gets tricky. The majority of silver production, roughly 70%, comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Only about 30% comes from primary silver mines. This means that silver supply is relatively inelastic. If the price of silver doubles, it doesn't necessarily mean that silver production will increase proportionally, because most silver miners aren't primarily mining for silver. They're mining for copper or other base metals, and silver is just a bonus. This supply inelasticity means that when demand increases significantly, prices can move dramatically because supply can't respond quickly enough to restore balance. We're also seeing interesting dynamics in the recycling market. Silver is recyclable, and historically, a significant amount of supply has come from recycled material. But much of the silver used in modern industrial applications is consumed in such small quantities per unit that it's not economically viable to recover. The silver in your smartphone, for example, represents maybe 50 cents worth of metal. Nobody's going to spend the time and effort to extract that silver when the device is recycled. This means that industrial silver consumption is, in many cases, permanent destruction of above-ground supply. Over time, this creates a gradual tightening of the supply-demand balance, especially as industrial applications continue to expand. Let's talk about the geopolitical dimension of this situation as well, because silver, like many commodities, exists within a complex web of international relationships and strategic interests. China's dominance in solar panel manufacturing gives them significant leverage in the silver market. If Chinese manufacturers are willing to pay premium prices to secure silver supply, it affects global pricing and availability. Similarly, if trade tensions or geopolitical conflicts disrupt the flow of silver between regions, it can create the kind of price dislocations we're seeing now between Shanghai and Western exchanges. There's also the question of strategic stockpiling. Governments and large industrial users sometimes build strategic reserves of critical materials to ensure supply during periods of disruption. If Chinese entities, whether government-backed or private, are engaged in a strategic stockpiling campaign for silver, it would explain both the elevated prices in Shanghai and the willingness to pay premiums that seem irrational from a pure arbitrage perspective. They might be placing a value on supply security that goes beyond simple spot price considerations. The physical delivery situation with bullion dealers is another data point worth examining. Reports from retail bullion dealers indicate delivery delays of 4 to 6 weeks for certain silver products. Now, some delay is always normal in the physical precious metals market. Coins and bars need to be minted, quality checked, and shipped. But 6-week delays are on the longer end of the spectrum and suggest that refineries and mints are struggling to keep up with demand. This is consistent with a market where physical supply is tighter than paper markets might suggest. This disconnect between paper and physical markets is crucial to understand. When you buy a silver futures contract on COMEX, you're not buying physical silver. You're buying a financial derivative that's linked to the price of silver but doesn't necessarily involve any actual metal. The COMEX warehouse stocks represent physical silver that backs a portion of these paper contracts. But the ratio of paper claims to physical metal is many times over. This is normal and expected in a futures market, but it means that the paper price can diverge from the physical price, especially during periods of stress. If everyone who owned a silver futures contract suddenly demanded physical delivery, there wouldn't be nearly enough metal to satisfy those claims. The system depends on the assumption that most traders don't want physical delivery, they just want price exposure. What we're potentially seeing now is an increase in the number of traders and investors who do want physical delivery. Maybe they don't trust the paper markets. Maybe they're concerned about counterparty risk. Maybe they simply believe that physical possession provides security that financial contracts don't. Whatever the reason, increased demand for physical delivery puts stress on a system designed primarily for financial trading rather than physical commodity transfer. This stress manifests as higher premiums for physical metal, longer delivery times, and eventually, if the stress is severe enough, price dislocations like the Shanghai premium we're seeing now. I want to address something that often comes up in discussions of precious metals markets, which is the question of manipulation. There have been numerous allegations over the years that large banks manipulate gold and silver prices through concentrated short positions, spoofing, or other trading tactics. Several major banks have actually been fined by regulators for manipulative trading in precious metals markets. In 2020, JP Morgan Chase paid nearly $1 billion in fines to settle spoofing and manipulation charges. Other banks have faced similar penalties. So manipulation is not just a conspiracy theory, it's a documented reality that regulators have acknowledged and punished. The question is whether manipulation is happening now, and if so, what impact it has on the current price action. Manipulation typically involves keeping prices artificially suppressed through various trading tactics. If large banks or other entities have been suppressing silver prices, and that suppression is now failing, it could contribute to the explosive price moves we're seeing in Shanghai. A failed manipulation attempt often results in even more dramatic price moves than would occur naturally because accumulated pressure is released all at once. Think of it like holding a spring compressed for a long time. When you finally let go, it springs back with extra force. However, proving manipulation in real time is nearly impossible. Market participants can only see their own trades and whatever public data exchanges release. The full picture of who's doing what, with what intent, isn't available until long after the fact, if ever. So while we can acknowledge that manipulation has occurred historically and is a genuine phenomenon in precious metals markets, we can't definitively say whether the current price action represents a failed manipulation attempt or simply reflects underlying supply-demand fundamentals finally asserting themselves. Let me bring up another important consideration, which is the role of ETFs and investment vehicles in the silver market. Silver ETFs like SLV hold hundreds of millions of ounces of physical silver in vaults to back their shares. When investors buy shares of these ETFs, the funds are supposed to purchase physical silver to maintain their backing ratio. This creates investment demand that directly impacts the physical market. If we see large inflows into silver ETFs, it would suggest that investment demand is increasing, which would tighten physical supply and put upward pressure on prices. Conversely, outflows from ETFs release silver back into the market and ease supply constraints. Recent data on ETF holdings has been mixed. Some silver ETFs have seen modest inflows, while others have experienced outflows. This suggests that investment demand is present, but not overwhelming. If we were seeing massive investment demand comparable to what occurred in 2020 during the Wall Street bet silver squeeze attempt, ETF inflows would be much larger and more consistent. The fact that investment demand is relatively moderate makes the current price dislocation even more interesting because it suggests that industrial and physical demand, rather than speculative investment demand, is driving the tightness in the market. Now, let's consider what all of this means for the average person who isn't actively trading silver futures or running an industrial company. Why should someone care about silver premiums in Shanghai or inventory levels on COMEX? The answer is that commodity markets are leading indicators of broader economic trends. When we see stress in commodity markets, it often foreshadows changes in inflation, currency values, trade flows, or economic growth. Silver's dual nature as both an industrial and monetary metal makes it particularly interesting, because price moves can reflect either industrial demand growth or monetary concerns, or both simultaneously. If silver prices rise significantly from current levels, it will feed through to higher costs for manufacturers who use silver in their products. Solar panel costs could increase, electronics could become more expensive, and any industry that relies on silver as an input would face margin pressure or need to pass costs through to consumers. This contributes to inflation and affects everyone, not just silver investors. Conversely, if silver prices stay suppressed despite tight physical markets, it might indicate that something is broken in the price discovery mechanism, which has its own set of concerning implications about how commodity markets function and whether prices accurately reflect supply and demand. The currency implications are also worth considering. Precious metals. Prices don't exist in a vacuum. They're quoted in currencies, primarily US dollars. If silver prices rise dramatically, it could reflect not just increasing demand for silver, but also decreasing confidence in the dollar or other fiat currencies. This is especially relevant given current concerns about government debt levels, central bank policies, and long-term inflation prospects. A significant move in silver could be an early warning sign that investors are starting to lose confidence in paper assets and are seeking alternatives. I also want to touch on the technical analysis side of this situation because chart patterns and technical indicators can provide additional context. Silver has been consolidating in a range between roughly $22 and $30 for an extended period. In technical analysis terms, a long consolidation period often precedes a significant breakout, either to the upside or downside. The longer the consolidation, the more powerful the eventual move tends to be. If silver breaks decisively above the $30 level and holds, technical traders will likely interpret that as a bullish signal and pile in on the long side, creating additional momentum. Conversely, A break below $22 would trigger stops and likely lead to further selling. The Shanghai premium complicates the technical picture because we now effectively have two different silver markets trading at vastly different prices. Which one is right? Which one reflects the true market clearing price? These are philosophical questions as much as analytical ones. In an efficient market, both prices would converge through arbitrage. The fact that they haven't suggests inefficiency, but determining which price should adjust requires making assumptions about why the arbitrage mechanism has failed. If it's failed because physical silver truly is scarce and difficult to transport to China, then arguably the Shanghai price is more accurate and Western prices need to rise. If it's failed due to temporary regulatory or logistical issues specific to China, then perhaps Shanghai prices will fall back toward Western levels. Let's also consider the potential for this situation to spread to other precious metals. Gold has also seen elevated premiums in certain Asian markets, though nothing as extreme as what we're seeing with silver. Platinum and palladium, which have significant industrial applications, particularly in automotive catalytic converters, have their own supply-demand dynamics but could be affected by broader precious metal sentiment. If silver experiences a genuine squeeze and prices spike, it would likely increase interest in all precious metals as investors seek exposure to the sector. This could create spillover effects across the entire complex. The mining sector is another dimension worth examining. Silver mining companies would obviously benefit from higher silver prices, but there's often a lag between spot price increases and improved mining company profitability. Mines have long development timelines, significant capital requirements, and various operational risks. A sustained increase in silver prices would eventually lead to increased mining activity and expanded production, but this takes years to materialize. In the short to medium term, existing producers would see windfall profits if prices spike, while new mine development would increase supply in the longer term and eventually help restore market balance. One thing I find particularly fascinating about the current situation is how it demonstrates the increasing complexity and interconnectedness of global commodity markets. The Shanghai premium isn't happening in isolation. It's connected to Chinese industrial policy, global trade patterns, currency flows, derivatives markets, physical logistics networks, and regulatory frameworks across multiple jurisdictions. Understanding what's really happening requires synthesizing information from all of these domains. This is why simplistic narratives about manipulation or shortages often miss the full picture. Reality is messy and multifaceted, and markets respond to numerous variables simultaneously. As we move forward, several key indicators will help us understand how this situation develops. First, watch COMEX inventory levels. If registered and eligible stocks continue declining at current rates, it would reinforce the supply shortage narrative. Second, monitor the Shanghai premium. If it widens further beyond $77, it suggests increasing desperation for physical metal in China. If it narrows back toward Western prices, it indicates that the dislocation is resolving. Third, pay attention to ETF flows. Large inflows would suggest growing investment demand and could trigger a broader move. Fourth, track industrial demand indicators, particularly in the solar sector, to understand whether physical consumption is genuinely accelerating. Fifth, watch for any further margin requirement increases or exchange rule changes, as these would signal increasing stress in the derivatives markets. The coming weeks and months will be absolutely critical for determining whether this situation escalates into a genuine crisis or resolves peacefully. Markets have a way of remaining irrational longer than participants expect, but they also have a way of resolving imbalances eventually. Physics applies to markets. Pressure builds until something gives. The question is, what gives and when? Does the Shanghai premium collapse? Do Western prices rise dramatically? Does physical supply suddenly materialize from unexpected sources? Do regulations change to facilitate arbitrage? Does industrial demand moderate? Any of these outcomes is possible, and the actual resolution might involve a combination of factors. For anyone trying to navigate this environment, whether as a trader, investor, or simply an interested observer, the key is to remain flexible, gather information from multiple sources, question assumptions, and avoid overconfidence in any particular narrative. Markets are humbling, and precious metals markets are particularly volatile and unpredictable. The fact that silver has reached $77 in Shanghai is objectively significant and represents a major market dislocation. What it means for future prices and whether it represents an opportunity or a warning depends on factors that are still unfolding and about which reasonable people can disagree. If you've made it this far in the video, I genuinely appreciate your attention and engagement with this complex topic. Understanding commodity markets requires patience and willingness to grapple with nuance, and the fact that you're still here tells me you're serious about learning. If you found this analysis valuable, please hit that like button, subscribe to the channel, and turn on notifications so you don't miss future updates as this situation develops. I'll be tracking these markets closely and providing regular analysis as new data becomes available. Drop a comment below with your thoughts on where you think silver prices are headed and why. I read every comment and love engaging with the community. Remember, this is educational content for informational purposes only, not financial advice. Always do your own research, consult with licensed professionals, and never invest more than you can afford to lose. Thanks for watching, and I'll see you in the next video.